Uh, okay, well, welcome everyone to ACG Silicon Valley's M&A Circle, an event on how the international M&A landscape is shifting. For those of you who don't know me, I'm Yvonne Schwab, ACG Silicon Valley's CEO. And for those of you new to ACG Silicon Valley, we are the leading business-to-business networking organization in Silicon Valley, providing connections, thought leadership, and enabling personal and organizational growth. I wanted to take this opportunity to let you know about a bunch of events that we have coming up, both virtual and in person. On August 10th, we have the Future of Work, how to leverage remote work trends to reduce operational costs. On August 11th, we are co-promoting a corporate board readiness virtual workshop with How Women Lead. On August 12th, we have our first in-person event. I'm so excited. Post-pandemic, that is, on creating the next normal at the Pullman Hotel in Redwood Shores. Space for this event is limited, extremely limited. So make sure to register ASAP if you're interested in joining us. Also in August, we have an event titled A Renaissance in IP Asset Management, Building a Better Mousetrap. And many more events are to follow in Q3 and Q4. So we invite you to visit our website, acgsv.org, to see the full calendar. Now, I would like to thank our sponsor, RSM, for putting together today's event and being such a great supporter of ACG Silicon Valley. And without further ado, I will hand over to Rob to introduce himself and get us started. Thank you.
Thanks, Yvonne. Also, Reed Smith is supporting in our presentation today as well. So just wanted to make sure they'll introduce themselves. My name is Rob Schmidt. I'm an international tax partner at RSM in San Francisco. I've been working in the international tax arena for 26 years. And I am a member of our West Region and national M&A team, thinking it through and supporting international transactions. So with that, Jeff, do you want to introduce yourself, please?
Thank you. I'm Jeff Kornblatt. I'm based in Washington, D.C., and I'm an international tax partner at Reed Smith. I've been practicing about 20 years, and I focus on all types of business transactions, cross-border, inbound, outbound, and on transfer pricing, an area which I've been reasonably active in over the years. And it's a pleasure to be having an opportunity to speak to all of you today.
Koen, you want to introduce yourself?
Yeah, of course. My name is Koen Dekker. I'm an international tax partner at RSM in the Netherlands. I'm located in the city of Eindhoven, so the southern part of the Netherlands. I'm in international tax since 2002, so it's also 20 years. Yeah, I'm responsible for the international tax practice in the Netherlands.
Fantastic. So let's get started. So today we're going to talk about the changing landscape for multinational and digital services companies. We're really looking at kind of proposals that are being put forward by the OECD, how Europe is addressing those proposals, how U.S. tax proposals under the Biden administration is addressing these proposals, and then quickly talking about transparency and shell company requirements in Europe and how that is having immediate impact on transactions that we're seeing. And then finally, we're going to backstop that with a short discussion on digital services taxes, which are being implemented currently in Europe as a fallback to the potential failure to implement the OECD proposals. And so with that, let's move into the first section here, which is the OECD Pillar 1 and Pillar 2. A little bit of background. Since approximately 2017, the OECD, the Organization of Economic Cooperation and Development, which includes most of the G20 countries, has been formulating action plans for base erosion profit shifting activities, which essentially is known as BEPS, with the idea that large multinationals and all international companies have been shifting their profits to low tax or no tax jurisdictions with the goal of avoiding taxation on their profits. And so the OECD has approached this with a couple of different proposals. BEPS 1, which was issued in 2017 and is being implemented in Europe and the US in various ways through their changing tax laws. And then most recently, the BEPS 2 proposal, which is what we're going to be talking about today. These proposals are still in the proposal stage, although the Europeans and the Biden administration are looking at ways to implement these proposals. So with that, let's move into pillar number 1. Pillar number 1 is designed to address digital economy, profit allocation, and nexus rules for digital service companies. So generally, what is this? This is a proposal to tax digital services companies in the location where their services are being consumed in their market jurisdiction. So how do they intend to do that? Well, they're proposing to revise profit allocation and nexus rules, essentially to look at global taxable income and who could tax that income in the digital economy. The proposal is essentially suggesting that a portion of the residual profit should be taxed where the revenue is sourced, the market jurisdiction. And alternatively, they're going to be looking at this through a broad scope application to any company that provides automated digital services and consumer-facing businesses. Those are pretty broad definitions. The definitions are still have to be worked out and implemented, but it can hit a lot of different types of businesses. This is going to shift the right to tax based on source revenue really away from the physical presence test, which has been the standard since essentially, for the last 90 years, and into much more of an intangible presence test, a market-based test. How are they going to do this? The core components. Well, under pillar 1, what we're looking at here is they're going to push residual profits to the market jurisdiction. So if we think about residual profits, that's everything left over after profits have been shifted elsewhere to compensate for other services or functions that are supporting the business. Currently, these thresholds to be captured in these rules is a global revenue of 750 million euro gross revenue, which is approximately 640 million of gross revenue. And so you'd be looking at that from an affiliated group across the multinational organization. The scope of the consumer-facing business and automated digital services is a big issue. There's a lot to work out there, and in implementation, countries will need to determine how those things are defined. The nexus rules for shifting potential profit reallocation, those are super interesting as well, because if you think about if you have a single company selling into one jurisdiction, it may not be that difficult. If you have a company selling or advertising into multiple jurisdictions, then allocating to the separate jurisdiction becomes much more difficult. Other issues that are on the table that still have to be resolved are how do we carry forward losses in each of the jurisdictions? If we're investing in a country and we don't have the consumer base yet to support the revenue, what happens to those losses? Do we get credit for them in the future? And then finally, elimination of double taxation. How's that going to occur within our tax treaty network? And finally, whether a fixed return on marketing and distribution activities supporting the business is going to be established in a safe harbor or established under standard transfer pricing rules. So let's move into a quick example. In our current system, if we have a U.S. social network company with no employees or servers or advertisers, advertising sales agents in Germany, for example, but has a large user base in Germany, currently there is no German tax. There's no German income tax or consumption tax on those activities. Pillar 1 is proposing to reallocate those profits so that Germany will be able to tax the profits allocable and attributable to their user base, the value created and the profitability in their jurisdiction. And that's what these rules are essentially attempting to do. So what are our observations? If you have a company that's below $750 million euro or million euros or 640, currently you don't really need to worry about this. But this is, we think, a harbinger of the future as things are implemented and countries determine that they can move these rules forward. I think we will, my feeling is that smaller companies will be eventually consumed by these rules and have to implement these requirements. The important thing here is that one of the challenges here is that transfer pricing, traditional transfer pricing allocations and rules are kind of out the window. I mean, the Europeans would like a kind of a fixed return on the residual profits, and the U.S. is trying to push for more of a transfer pricing based return. But as some of you may realize, separating out the consumer intangibles from the platform intangibles, from the R&D services, from the management services, all of that slicing and dicing in the transfer pricing world gets very complicated, subject to a lot of debate between economists. And I would anticipate governments, their internal transfer pricing teams disagreeing and trying to grab more of the revenue, which would lead to potentially competent authority issues or double taxation issues. So with that, I'd like Jeff to if he has additional comments on and observations about Pillar 1.
Thanks, Rob. Yeah, I would. At the risk of sort of soapboxing here a little bit, I would say this is going to be a real sea change, and it's been a long time coming. I think Rob explained the background of the OECD's BEPS initiative going back quite some years now, and I think everybody listening in probably is familiar with it to a greater or lesser extent. They'll recall that the first item was dealing with digital economy, which was not resolved when the first set of BEPS rules came through. And I think that's for a variety of reasons. And one of them is under any circumstances, these rules are going to be very complex. They're going to be a real change from the historic operating mechanism, whereas you had to have some kind of presence, at least to an agent. And so this means with a lot of, as the economy has dramatically changed over the last 20 years, a big gap was left. And the question is, well, how would that be addressed? And it's just my own personal opinion, but I think the United States entered the BEPS process believing it was going to primarily enable them to better tax the residuals that were resulting in low tax jurisdictions from all the planning that had been occurring for some decades. I think a lot of the market countries in a whole variety of areas concluded, no, this is an opportunity really for us to put our hat in the ring for the revenue. And so the U.S. found itself playing defense through a lot of BEPS, and one area certainly was digital economy. Many people listening in right now, you're in large companies that are key players in this, and so the U.S. has a lot at risk here, and simply empowering market jurisdictions to go after what they consider ultimately to be the revenues that belong to the U.S. fisc, that's been very, very difficult. So you've got a big difference between the U.S. market's view and many of its trading partners. You've got a significant step away from the historic 90-year-old practice of how we've determined when do we tax transnational border events and transactions. We've got a proposed, really what's going to start to look somewhat more like some of the state tax positions we've seen evolving, something moving away from arm's length to apportionment methodology. And of course, and we'll talk a little bit more about this later, we have a lot of countries that have made some movements, in some cases significant, in other cases they're thinking about it, of doing unilateral action. And so this pillar is moving forward. It is, I think the United States sees it in its interest ultimately to at least come to the table with everybody to have a methodology, but there's a lot that's uncertain as to how it will be calculated, how it will be applied, how it will interact with historic methodologies, including arm's length positions, and how the companies that will be subjected to it will be expected to account for what they've done, to pay for what they've done, and to memorialize it. So the message on this one is just, this will, in the end, have a huge impact, I think, on international taxation for many, many players in the economy that they just up till now have not had to worry about. There's a lot yet to be resolved, but it's coming. Something to keep an eye on. And as Rob mentioned, despite the fact that right now the threshold of 750 million euros is significant, I think that once the blueprint's out there, you're going to see the national needs for revenues will continue to drive efforts to at least discreetly go after certain players and maybe just continue to lower the overall approaches. Cohen. Oops, sorry, I cut myself off. Rob, I'm not sure if you have some observations, or Cohen, if you had something you wanted to add in from the European perspective.
No, I think one of the most important things is that you see that there is a movement now. I know that like in 2010, the whole discussion started. And at that time, we said in our office, yeah, that will take a while before we make some steps forward. And what you see now is that the G7 and the OECD really make step forward. And I think in their perception, the time is right to take these steps. So to be honest, I totally agree with you, Jeff, that it's coming up for sure.
Fantastic. So next we're going to turn to Pillar 2, and Jeff's going to walk us through that.
Thanks a lot, Rob. Okay, so Pillar 2 is this is, again, BEPS, the base erosion and profit shifting 2.0. And the two key elements of it are Pillar 1 and Pillar 2, and they are somewhat interconnected. We'll talk about potential coordination rules. But this rule is, I think, in some ways best analogized to the US GILTI rule, which is that if there is a structure out there where low tax is being paid by a member of a multinational, that there will be a minimum tax imposed. And that fundamentally would be it, which is, we'll show you an illustration in a moment. This is moving much, although this ultimately coordination-wise, if Pillar 1 and Pillar 2 are both implemented, Pillar 2 might be applied procedurally after Pillar 1 is taken care of. I think we'll see actual implementation of Pillar 2 ahead of that. There is a strong consensus now on what this should look like. There's still a lot of details to be worked out, but there's a consensus that this should start to come into play. And so what does it look like? As I said, the effort right now is to impose at least a 15% tax on a country-by-country basis. So if you've got a multinational group where essentially profits coming into a low tax jurisdiction, and this is not to be a zero tax jurisdiction, right? It could be a jurisdiction such as Ireland, where you have a rate that, at least today, it would fall below that. And there's also debate as how low that rate should be. Should be 15? Should it go up? There's been pressure from some countries to push that rate up higher. But assuming that you had that 15% rate coming in, a connection of basically 4 interconnected rules would operate, so that they would look through this so-called income inclusion rule, which will be backed up, sort of backstopped by this undertax payment rule, with 2 further tax rules that will come in and try to resolve problems that can arise with certain elements of this. The idea would be that there would be a topping off, which we paid at the parent level, and that this would bring up the end result being that there'd be no low tax pockets sitting within the overall multinational group. I think we could pop onto the next slide. Rob, if you could. Okay, thank you. So the limitation is that this is meant ultimately to be coordinated with Pillar 1. And so, at least for right now, we're going to see the same sort of threshold for application, which is 750 million euros gross revenue for a multinational group worldwide. Whether this could grow and expand just as the other might, I think certainly it probably will. You'll note that this is similar to, as I mentioned before, GILTI. And as a matter of fact, coordination with GILTI, which is not going to be repealed, even if this is implemented, is one of the key negotiations that's ongoing right now. And just like GILTI does not have that kind of a revenue threshold, I suspect this, if successfully implemented, may also start to sneak down. We could go to the next slide. There is, and people who've dealt with GILTI will see this looks somewhat familiar. There's a formulaic carve out right now that would be associated with a markup. You can see it's going to be higher during a transition period, and then it'll shrink, so you'll have less opportunity to shelter income. That would be associated with a markup on tangible assets and payroll. This is something that's still being debated in some significant element. The global ambition that's been expressed by the OECD is that this is supposed to have minimal impact on businesses and not to really materially inconvenience or materially change the tax rate for companies that are involved in substantive activities throughout their various different affiliates. I don't think that's going to be the case. I think just like GILTI, you're going to find it's going to hit both pure tax-driven structures and quite substantive structures as well. And you really aren't going to be able to, I don't think there's going to be any kind of objective basis to formulate a safe harbor saying, oh, well, I was sufficiently active, sufficiently substantive. You can see down on the bottom of this slide that the anticipation right now is that this is going to be brought into domestic law in 2022. And so countries will adopt it. There may be form legislation that they'll use, and that in fact, if they want to, it's going to have to look a certain way as it's adopted country by country. There may be a multilateral instrument aspect as well, but it's coming quickly if you look at that timeline. We can show real quickly, and there we go, an example. This is not showing you any of the specific mechanisms, but here's the concept. You got a US parent with 21% corporate rate, maybe 28% soon, who knows? And it has a Cayman entity that is engaged in activities that are sufficiently active that they're not being sucked up by the subpart F, by are there any deferral rules. And let's for a moment ignore GILTI. Or let's assume that for other reasons that you were in the calculations, GILTI was not fully applying here. You can see what would happen is through the analysis and the methodology and the application of the 4 rules we mentioned, ultimately the zero tax rate out, the profits that are being taxed at a 0% rate will give rise to an additional 15% tax obligation, which is going to be payable at the parent level. So I think we've got some observations, and I invite both Rob and Glenn to join us in and give us their thoughts. I think that I'll just throw out there that the carve-outs are going to be, I think, debated significantly, and it's not clear exactly what they'll be. They'll probably, my guess is they'll be done in various iterations. It is not clear yet for US, as most people listening in, for US-based multinationals, how well this will be coordinated with the seemingly ever proliferating US GILTI rules and anti-inversion rules and anti-deferral rules, but that's going to happen because the US rules are not going to just go away. And you'll note this is going to override a lot of fundamental treaty provisions in elements. So those are just some of my thoughts as I've looked at this. I'd also note there's really no mechanism that's been discussed yet for resolving controversies for competent authority. And as we all know from having seen a lot of treaty and other tax discussions, that's not easy, especially where we are thinking then about how this will interact with Pillar 1 when that comes out. So those are my thoughts as I see this unfolding. Rob, you or Cohen, have you got things that struck you as you looked at this?
Couldn't comment. I don't have anything to add at this point.
No, me neither. It's clear.
Fantastic. Then let's move over. Thanks, Jeff. So let's move forward then into what's going on in Europe with BEFIT and the European Union addressing these issues. And could you walk us through that?
Yeah, of course. The 18th of May recently, so European Commission presented new plans for the corporate income tax in Europe. And basically what they say is what already is mentioned by Rob and by Jeff, is that our tax system is a bit outdated also in Europe, really looking to physical presence, and physical presence nowadays is less important, definitely after what we saw in the COVID-19 and people working from home. So basically what Europe says is that we want to implement Pillar 1 and Pillar 2. So they fully agree with that, but they also want to go beyond Pillar 1 and Pillar 2 and more create a single market in Europe. And there they want to simplify the structure, create more fairness, like that's what everybody says, and more efficiency. Because what we see in Europe, at least, is that now I think more than 50% of the tax income is created by labor tax and social security. And then you still have VAT, which is a huge amount of tax income. VAT is the highest ever. And corporate income tax is, in the Netherlands at least, only 6.7% of the total income. So they want to divide it more fairly, basically, and create what they say a robust and efficient and fair tax framework that meets public financing needs while also supports recovery and the green and digital transition by creating a sustainable and job-rich growth. That's basically what Europe says with the plans they presented now. And there are basically, basically 5 topics which are in these plans. And the first 2 mainly have to deal with the fairness and effective taxation. So the first one is legislative proposal for the publication of the effective tax rate paid by large companies. And there they link to the Pillar 2, so the companies which are above the 750 million turnover. And basically what they want to see is how the tax is deviated between the countries in Europe. So that they create more transparency and make sure that the effective tax rate is more in line what they emphasize, basically. And they do it like Pillar 2 based on commercial figures and not the taxable basis. The second is a proposal to neutralize and to misuse of shelf companies. What we see in Europe still, and maybe the Netherlands is a great example of that. There are a lot of holding companies. Luxembourg has the same. And they want to prevent the misuse of those entities. And the next slide, we go in a bit more detail. And it's already mentioned ATAP 3. So that will come up as well. And by the way, I think it's good to mention that all these plans the European Union wants to realize within 2 years. So that's quite an ambitious plan. The recommendation on domestic treatment of losses, that has more to do with COVID-19. So they recommended in a Q&A on the report they send out that countries have to allow the possibility to compensate losses in the way of carry back. In most countries, at least in the Netherlands, it's already possible to carry back for 1 year. But here in the Q&A, they said that countries have to create something that the carry back can be used. That will be published somewhere in a directive, I think, at the beginning of 2022. And then a legislative proposal creating a debt equity PS reduction allowance, DEBRA, like it's called. And here's also, I think at least when I was in the university, and they already discussed on the fact, on the question, basically whether it's honest that debt and interest on debt is deductible. And if you put equity in a company, then you have no deduction at all. A lot of private equity firms, of course, and the leverage is important. And you see in Europe, at least, a debate going on whether companies have to be leveraged at the maximum. So they want to reduce, on a positive way, I think, the leverage, and basically create something which was already in place in Belgium for a while, the notional interest deduction. So they create something that if you put equity in your company instead of debt, that you can create a kind of a version of an interest deduction, which will be deductible from your profits. And if that is all realized, then they want to do BEFIT, so Business in Europe Framework for Income Taxation. That is a robust new framework, which, in my opinion, goes a bit beyond Pillar 1 and Pillar 2, what already is mentioned by Rob, the deviation of transfer pricing. Here they want to create basically a European single market. So that means that the European profit will be deviated between countries based on a kind of a formula. And that formula will be based on sales, based on employees, and based on tangibles. The exact formula is not familiar, of course, at this stage, but it will also replace the transfer pricing, because the deviation of the profit and the profit split between the countries will be based on that formula. How that exactly will work out between the US and Europe, that's not clear for me at this stage, because you can think of a lot of exemptions where you get double taxation or non-taxation or whatever. And I think all those rules are basically born in a way to prevent those things. So I'm sure that they come up with something. As already mentioned, the misuse of shell companies. What they want to prevent is that they have shell companies in Europe, take as an example an EU holding in the Netherlands, without any substance. Good examples, I think, which are very familiar, are the Rolling Stones or U2, who have a company in the Netherlands, make use of the tax treaties between the Netherlands, and no royalty withholding tax on royalties is due in the Netherlands, so you make use of that. What they want to prevent is that it is not possible anymore to make payments upstream to the EU holdco company without withholding any withholding taxes. So probably you get new forms which you have to provide and to give evidence that the holding company in Europe has at least enough substance and real economic power to lead these subsidiaries, and therefore is able to make use of all those opportunities. Business in Europe and framework for income taxation. Already said, the Commission will introduce a single corporate tax rule book and a common tax base and the allocation based on the formula. Yeah, that will really replace the transfer pricing and the formula. I think big countries in Europe like Germany, which have a lot of customers, of course, will probably have a lot of advantage basically on those rules, and smaller countries like Luxembourg or maybe the Netherlands or other countries, it will work out differently. There's some examples, I think, which you can imagine. But the exact impact, it's not clear. What should we do now? That's a good question. I think for international organizations, it's important to see what the effective tax rate is right now. I think it's also good that you can already start and thinking, where are my customers? Where is my business? To see how that might be impacting your business, because what we already said, it's coming up for sure. Transfer pricing functions from lower tax jurisdiction to market jurisdictions. Already said, transfer pricing, it's always a debate. It's never clear. And that's also the reason why the European Union wants to change the rules and make it more robust, basically. And review your current structure. Make sure that if you have dormant holding entities, which we at least see in the Netherlands quite a lot still, because it's old business or old holding. Recently I saw one in international structures set up in 1990. Yeah, that's a long time ago, and there was no substance at all. So yeah, you get questions by the Dutch tax authorities, and the Dutch tax authorities is less interesting, but it was an example that the Belgian tax authorities said, yeah, if there's no substance in the Netherlands, then we look through the Dutch entity and deny it basically, and then you have withholding taxes in this particular situation. So that is important, I think, to double check your structures. Yeah, I think some of those takeaways are already mentioned. So the 50% minimum tax question, do you have in your structure entities, Cayman, whatever, which don't have the 50% minimum tax? And then is the question, what can we do? What are the opportunities and benefits for the interest and royalty directive? Currently, we have a dormant holding, or there is only a trust office involved. That is in the future not sufficient anymore. So at least you have to give it some thoughts on how you will take this out of your structure or make it more robust, that it's still applicable. What already said, in which countries do I sell my products? It's important because I think that sales will be one of the key drivers to allocate profits in the near future. Yeah, I think that are the most important takeaways.
I'm going to throw a question out to you.
Of course.
Thank you. As I've read my own commentaries out there that on BEFIT, and I know this is a big question, so just high level, what's the expectation of how that will advance at the same time that the OECD pillars are advancing, and considering how there might be unresolved tensions? I mean, one using a different apportionment and allocation system that might deviate from that of, for example, Pillar 2. Do you think that is going to arise where you have two separate systems standing side by side, and maybe the BEFIT one will prevail for European companies in doing inter-European transactions, but for example, for a US multinational, that's going to have to show why it was allocating back to the US tax authorities, why it was allocating certain payments or certain transactions, certain losses, whatever, amongst its European members. It's almost going to have a parallel set of books, a parallel set of systems, one to turn around and deal with the allocation methodology that may arise and be put into place under BEFIT or something similar, and one that would be under either its US rules or whatever they agreed to under BEPS 1 and 2, on Pillar 1 and 2. Do you foresee that as an outcome, or do you think it'll ultimately be resolved that one will take precedence?
Yeah, that's a good question, because the rules are not clear yet, of course, but they definitely say, the European Commission, that they take into account everything is also based on Pillar 1 and Pillar 2, but they go a bit beyond that. So my thought is that they take basically Pillar 1 and Pillar 2 and take that European profit, and that is the profit for Europe, and then divide, as they say, as a kind of a single market. So that is the profit instead of one company. Now Europe is one company, and then divide the profit into Europe to the different countries. So that's how I see it currently, that they are trying to do.
Similar to a consolidated return with state allocations then at that point.
Mm-hmm. Mm-hmm.
Right. And Koen, what's your perspective on, I know we have these holding companies and dormant company rules. We're seeing in M&A transactions lots of concern about wanting to set up a holding company to perhaps consolidate an acquisition or two acquisitions, portfolio companies under one ownership structure, because they will plug into one another, but they don't want to have the new target, say, held by a European holding company or European operating company in one jurisdiction or the other. What are you seeing there? I mean, are you seeing people eliminate their holding companies, or putting, taking efforts to put substance into newly established aggregating entities?
Yeah, typically what we see is that they put substance in those entities now. Because it's a real question. I see some multinationals having a lot of holding companies out of the past, and they basically dissolute those entities because they have no added value anymore, and just make a new decision on which country would be the best to have that holding company. And if you have that holding company in Europe, then you create also real substance. So you really have economic value in that holding company more than a trust office, put it that way.
Excellent. All right, let's move on. We're kind of pushing up against our time a bit. Jeff, could you talk through the Biden proposals and the SHIELD plan?
Absolutely. So I will try to make this brief, since we are moving forward with and want to leave some time for interaction and questions. So the Biden proposals, status-wise, these right now are administrative proposals. There's not detailed statutory proposals out. They're not floating around, by and large, floating around in Congress yet. And so we've got high-level concepts on some of these, and other ones, particularly SHIELD. There's a lot of unanswered questions, but that sort of is the tune we keep playing here on this. There's a lot of unanswered questions, all of this. I want to reiterate again, just that much of what we're seeing on the international arena, this is not taking old older, at least international concepts, and just making their teeth sharper. It's a whole new set of teeth, and so we see that, and I think it just is it's a time when tax people are going to better be prepared to be very busy. There's going to be a lot of going on, a lot of modeling, a lot of remediation. So let's go to the U.S. rules. The U.S. rules, there's of course the proposal to pop the corporate income tax rate back up to 28%. That would, if left unaltered, have the impact of bringing GILTI up, at least right now, to 14%. But in fact, the proposal is to bring the effective rate under GILTI up to 21%. GILTI is going to be tightened up in a couple of other ways. Some of this echoes, the ongoing credit limitations in the foreign tax credit area, that we have gone on for decades. But basically, imposing jurisdiction by jurisdiction calculations, so that losses and tax credits in one jurisdiction can't be used to hype up and shelter what would otherwise be taxable income in other jurisdictions. At the same time, the SHIELD proposal has come out. We'll talk about that in a second. Because this is going to make being a U.S.-based company more expensive, there's a proposal to further tighten the already pretty tight U.S. anti-inversion rules. And last but not least, there would be a proposal to repeal the foreign-derived intangibles income deduction, which right now is sort of the carrot to the GILTI stick. The carrot would disappear, right? That would be gone. At the same time, there is separately a proposal to impose a 15% minimum tax. That sounds familiar, right? But this is a U.S. Proposal only on companies and on corporations that would have income in excess on a worldwide basis of $2 billion. I compare this to the 750 million of the OECD proposal. We've been corrected. I think that's right. The 750 is actually a much higher. It's closer to 890 US dollars right now under today's exchange rates. Obviously, that's going to shift back and forth. The 750 is sort of the standard there, but you can see this would be have a higher threshold. It stands to be seen how this would ultimately be coordinated with, and whether or not it would stay in place if the Pillar 2 were implemented. And then there will be tweaks again to the calculation of what's going to be subjected to these taxes. And so the carve-outs that we have under U.S. law currently for both FDII and for the GILTI rules that are going to qualifying assets, those would be taken away. So we can pop on to the next one. SHIELD is a specific proposal that bears a little bit of further exploration. So under the 2017 Act, BEFIT came in, which was an effort to reduce base erosion payments that might come out of the United States. And SHIELD would replace that regime with what is expected to be an even more vigorous regime. There's not a lot of details on SHIELD and how it will work, but effectively what it will do is it will deny deductions that are made if it appears based upon a group-wide series of deductions and a group-wide practices of making payments, that they are making payments to low tax members, to members within the group that are being taxed at a rate that's falling below a designated minimum tax rate, all right, or a DMTR. So the concept of SHIELD would be that if it looks like there are excess deductions coming out of the United States, eroding the U.S. tax base and going to these low tax jurisdictions, this would be, and presumably these are already ones that are going to not otherwise be fully dealt with under U.S. withholding taxes, then this regime will come into place and it will impose a level of tax, or either effectively doing that by denying the deductions. This will be coordinated, so it's stated with Pillar 2, when and if that comes into place. But in the meantime, the rate that's being proposed is 21%. And I'd note that we talked about the 15% rate for Pillar 2. The U.S. has at least put some proposals that would be 21%. So you can see this convergence here. like other proposals, this one would be coming into play in the next couple of years. This one's pushed out a little further. The other proposals we've talked about would take effect, again, if enacted, in 2022. This would come into play for tax years beginning after the end of calendar year 22.
So let's turn quickly to transparency requirements. We've talked about shell companies a bit. Koen, could you talk quickly about the transparency requirements that are coming our way in Europe?
Yeah, what already mentioned, that it is important to at least put in your report as of 2022, how much tax you pay per country. But that's my opinion. You currently see that a lot of companies make annual accounts, but those annual accounts, I think in the near future will be an annual report. And that report is, and part of the report are the annual accounts, of course, but Europe is also really pushing on a green economy. So I think there will be a sustainable report in it, or a report of sustainability, but also a kind of a tax report, which gives more transparency on which tax you pay in which country. We already see some organizations already do that, like Shell and Nationale and Nederland in the Netherlands. They make already those reports. So I think that is the near future in Europe, at least, and probably also other countries.
So get ready to set out more information in your financial reports in Europe. That's the message there.
Yeah, not only a tax line anymore, but a robust report, I think.
Right. All right, let's last topic here. We've been talking about the fact that we have this Pillar 1 digital services tax. What's really motivating some of these changes is that countries have adopted unilateral digital services taxes, and more countries are jumping into this, doing this in anticipation of grabbing their share of taxes while they can, until the OECD implementation takes place. And so this is a chart that is publicly available that is basically showing us kind of where some of these countries are and what actions they've taken through January of this year in regards to this, the digital services taxes. Again, these are taxes that would hit companies who are exploiting the market of countries and not paying taxes in those countries. And the thing to pay attention to here, some detail here, is that the threshold to be applicable to these taxes can actually be quite low. So for example, if you look at Italy and Spain, 3 million euros of domestic activity is pretty low. And so you wonder whether you may be subject to that beyond the 750 million global requirement, and same with Italy. So this list may continue to grow. It may not, depending on how the OECD Pillar 1 gets implemented and it gets adopted. I believe many countries have kind of put the brakes on some of these things until the OECD Pillar 1 is moving itself forward. So with that, I'll ask for comments from Jeff and Koen on this, and we can move to a question and answer with the panel. Fantastic. So let's this is some detail about us, and as we're displaying this, I invite questions of the panel here.
I'm going to jump in real quick. There is a question in the chat that I believe Koen would be good to address. The question is, a few related questions. My understanding is that the EU requires unanimity. How can this be implemented without the assent of Ireland and Liechtenstein? what will be the effect of Isle of Man?
Good question. Good question. Yeah, I think that basically Ireland is already mentioned as a country which has a corporate income tax below the 15%. I think there is no other choice for Ireland than just to go with the flow and follow the rest of Europe. So I cannot imagine. Ireland is of course not separately mentioned in the report of the Commission, but this is something that all 27 countries of the European Union have signed. So also Ireland.
And Liechtenstein and Isle of Man, are they part of the EU? I'm not even sure about that. I'm sorry.
Me neither. Isle of Man is very small island, of course, between the UK and France. I'm not 100% sure of that. And Liechtenstein, yeah, that's in Switzerland, small, like 100 square meters.
With lots of post office boxes, I think.
Yeah.
And people who should be worried about some of these rules, I would think as well. With the
yeah.
Yep.
Yeah, and Switzerland is, as an example, Switzerland is also not part of the EU, of course, but normally they will follow the rules of the EU, like the parent subsidiary directive is also something they follow.
Julia, are there other questions?
Nope, that's the only one in the chat, but if anyone has any additional, feel free to put them in the chat or even take yourself off mute if that's an option and chime in.
All right, it sounds like we're done, and thank you very much for your attention, everyone. And I know that everyone on the panel here appreciates that. And I know that this was an obscure topic, but a very interesting thing to pay attention to as we're moving forward and you're in the process of looking at your M&A transactions and considering acquisitions or sales moving forward. So thank you very much.
Thank you, everybody.
Yes, thank you so much for the insightful discussion. And I'm sure that everybody learned quite a bit. And thank you for participating to the panel. Thank you for attending, for everyone that joined us today. And please reach out if you have any follow-up questions, if you want to attend any of our upcoming events. And we'll see you soon.
Thank you, everyone. Bye-bye.
Thank you all. Bye.
Thank you.